Aloha everyone, Joshua Hayes at BigWaveTrading.com. On the surface, it appeared Friday's session was pretty good overall. The Dow Jones Industrial Average rallied, the S&P 500 rallied, the Nasdaq rallied, but what did the Russell 2000 do? Not rally. So, in strong market uptrends, you have markets rallying first off on accumulation, higher volume heavier than the session before, preferably above the past 50 days volume average. And also, the more broad indexes lead, the least broad indexes lag. On Friday, the most broad index, the Russell 2000, lagged, and the least broad, the Dow Jones Industrial Average, led. The other problem is, look at that volume in the Dow Jones Industrial Average today. Some of the lowest that we've seen all year long. How about the volume on the S&P 500? And the New York Stock Exchange? Well, below average and lower than the session before. Well, how about the Nasdaq? Same thing. Below average and less than the day before. What about the IWM? Oh, distribution day. Interesting. More and more of those big tall red bars showing up above the average line than those big tall green bars. So once again, we have a market rallying in V-shaped manner towards the old highs. This time around, though, despite the S&P 500, as you can see, the volume on the exchange ETFs, same thing. That's the SPY, that's the DIA, and that's the QQQ, all lower. But what's weird is that this time, with the S&P 500 near these recent highs, I have, instead of being nearly fully invested, am over 30% cash at the highest dollar amount level that I've had since this pullback started in the Russell 2000, basically back at the start of July, because we had that nice finish to June, looked like July was going to do well, but then we've gone nowhere since. Well, I was nearly fully invested here, all the way through here. Now, as the Dow Jones Industrial Average and S&P 500 and the Nasdaq nears those old highs, I'm 30% plus cash. Negative divergence everywhere. Also at the same time, while not breaking down yet, the New York Stock Exchange advanced decline line is still just treading water. And as the S&P 500 nears new highs, once again, there's no positive divergence in this line or leading of this line ahead of that index breaking out. If the S&P 500 hits new highs here and the Russell 2000 remains weak, chances are this line will once again show a negative divergence relative to the S&P 500. Since we're on these charts, let's go ahead and go back. I want to show you the indexes on these charts too. Let's start off with the Russell 2000, or here, let's just do it this way, the RUT. Look at the RSI. Each time we've had highs here in the Russell 2000, we have lower and lower highs in the RSI index. And as you can see here, lower and lower highs and lower lows on the MACD oscillator. So this is confirming the weakness in this index, and overall with us going into the seasonally bearish months, rolling periods of August, September, with August, September being the two consecutive worst months, as you can see. Now on percentage basis, September and October are the two worst months because October has a slightly less positive return than August. But if you look at the amount of time that October is higher compared to August, this in aggregate, with the percent returns and percent of the time it's higher, makes August and September the two worst months for stock returns. Therefore, what we're seeing is poor seasonality, poor breadth, poor leadership via that New York Stock Exchange advanced decline line we've seen and the Russell 2000 compared to those indexes, with the RSI and MACD oscillators leading the way down. Okay, so that's not good. So now let's go look at some of the other indexes. The Nasdaq. Well, we're trying to get back to the old highs. No positive divergence there. So that's not good for that oscillator. Not even close to having positive divergence here on this oscillator. So once again, not good overall. So now let's go look at the S&P 500. Similar situation. We're near those old highs. RSI not confirming MACD oscillator, not confirming. Now, like I said, it's not dire yet. The indexers are still clearly trending higher. We're still closer to the old recent highs than we are from trading below any major moving averages, even on the Russell 2000. You can see we're right at the 50-day moving average. So I'm hoping that we can consolidate sideways through August and September, get that volume starting to come back in on the upside in the market, hopefully no heavy distribution, and hopefully that kind of filters through the individual chart setups, because right now it's very lame out there. The signals have been weak. The confirmation and side scans to those signals have even been weaker. The quality of the long signals are lame. Once again, that's why you don't see 20% long positions, 10% long positions, 5% long positions. You continue to see these small, lower signal amounts, and that's why you don't see me guaranteeing or getting exciting over any kind of returns here. This is time to be protection. We've got a lot of weird mixed signals. There's no telling at all which way this market wants to move, because the stocks that I'm long overall look pretty good, but they're in that limbo area that it wouldn't take much selling to make them no longer look good. At the same time, with the markets being near old highs and the floor being there with share buybacks and just being an algorithm market that seems to just be buying every dip, it would not be smart to be bearish here at the same time. So it's hard to be bullish with the setups in the market overall. It's hard to be bearish, but things are looking like it could be bad, because if you take everything in aggregate, combine that with us being in August, September, the odds are in favor of this another V-shaped move higher, another V-shaped rally attempt on no accumulation, turning into the same way they just continuously turn into. So keep all that in mind as we move forward. Now, with all of that being said about the market, I wanted to focus on the market there, because now we're really getting into the heat of August and September when things can really weaken. I've already shut down my trading platform, but despite the relative weakness in the Russell 2000, my personal long positions, not a whole lot of intraday stops triggered today. It was actually a very orderly session. Now, that being said, on an end-of-day basis, look at all these full sell signals. IMMR, MCF, MMI, SBT, HUIA, which was just a recent long signal, and SRCLP. On top of that, these are the 50%ers. SIRS, RARE, SRI, OLBK, EPAM, HLNE, MSI, EAST, BZQ, NATH, CLPS. Session doesn't look as strong as the S&P 500 just made it look now, does it? That's a lot of sell signals for a session that was intraday for me and my stops orderly, and for a market that was higher on the session. So keep all that in mind as we now move in to the new long signals. The one and only one that probably everyone should focus on, and the only high quality quote quote safe signal this evening, is actually the new hedge signal, SRTY. SRTY giving me another pocket pivot point signal, this time on heavier volume, above average volume, and BOP is increased back to the green level. Well, with the way this market's looking and how weak the IWM is looking, this seems like a perfect time as any to definitely take a signal that you get from the SRTY. So there's definitely no way I'm passing on this one, even though it closed. It did more work, quote, quote, in the lower half of the range than the upper half of its intraday range. Do not care. Want to get a position short Russell 2000 here. Limit order, SRTY, 23.34. First cut loss level, right there, 22.51. Second one, right there, 22.17. Final one, right there, 21.70. 2% of my account capital. It made 2 scans, 1% for each. This thing would have made 5 scans, would have been 1% for each. Hedges are a priority here, not new long positions. And that then takes us into the 3 new long positions. None of these would have been new long positions had they not been in my most bullish and strongest scan, my perfect speculator scan. VRA, NOG, and EMX. These are your 3 new stock long positions. First off, VRA. This was in my perfect speculator scan, also made my tertiary scan, pocket pivot point signal, heavier above average volume, back to green bop. The reason why I want to take it long is because I like this overall chart pattern from the November lows. Once again, did less work, today, but I figure in the upper half of the range and the lower half of the range, but what I do is I figure that just lessens my risk. So limit order for VRA 1361 probably would be filled around 1340. I assume the market will probably gap lower Monday morning. First cut loss, you could use this low here, but for me, because it's only going to be 1% of my account capital, right here 1285, and then my emergency final cut loss level 1185. If you take VRA, only use that first stop level, ignore my final stop level. You only want to use one. Then EMX, I flagged this one a few sessions ago. Here it is, traded down to that pivot point breakout level, bouncing off of it on heavier volume while holding that max green bop. Made that scan and it's perfect speculator, but it's extended from its 20-day moving average and it's less than $5 with earnings coming up on the 14th. So with it being sub $5, I'm going to, 2 scans, normally be 1% total, reducing it in half because it's extended 0.5%, reducing it in half again because it's such a low price stock. But once again, this is probably the best overall signal out of the bunch of long signals. It's just pretty risky. Limit order is going to be at 128. First cut loss 118. Final cut loss 114. If you take it, you're only using 118. Once again, ignore that final level. And then NOG, a little bit more risky, but once again, higher quality, was in my perfect speculator stock scan. Couple of issues once again. Low price, got to be reduced in half. So instead of 1, it's 0.5. Sub 5, got to be reduced in half, 0.25. Keep in mind this stock has earnings on the 7th. So that's upcoming. So I just believe that everyone should avoid it. This is educational purpose trade only. NOG 369. First cut loss right there 350. Final cut loss 310. If you decide to go ahead and be a gambler like me, I'm not really gambling. I like this longer term chart. I think it's going to beat on earnings. I think it's under a ton of accumulation going to earnings. If it doesn't, I don't think it's going to gap down that much. And if it does, it'll hit my stops and I'll have small losses since it's such a small position. There's my reasoning behind the trade. 369 limit order. First cut loss and only cut loss everybody should obey. Right there 350. My finals 310. Everyone should only obey 350 there. So with all of these, just obey the first stop level, and the only safe trade is the short position in the Russell 2000 via SRTY. All right, everyone, have a great, fun, safe weekend. I will see you in the chat room Monday morning. Aloha.